At $85.7 billion, humanity's relentless push into space has just generated the largest initial public offering in history. Retail investors have awarded the company a valuation of $1.75 trillion. Look at the financial red flags. The $1.75 trillion valuation is heavily counterbalanced by a burning $4.9 billion annual operating loss. Expand the timeline, and that single-year loss compounds into $41 billion in accumulated historical losses. Because of the scale of these deficits, the standard math used to evaluate a company's health begins to break down. We cannot calculate a standard debt-to-equity ratio. The $41 billion in accumulated losses have entirely wiped out the company's equity, making the metric mathematically meaningless. We also cannot use EPS, or earnings per share. To calculate EPS, a company must have net income. Here, the income is entirely negative, offering no baseline anchor to justify the stock price. To find out what is actually holding up this valuation, our financial risk team conducted a strict forensic breakdown of the company's S1 prospectus. We are looking past the rockets to locate the real operational risks. We need to answer a specific paradox: why institutional fiduciaries are actively fleeing this stock, while retail investors are draining their savings accounts to buy it. The S1 document lists risks that test standard market logic, setting up a confrontation between the company's public-facing narrative and its internal operational math. Investors are drawn in by a highly visible success story. The Starlink satellite division is a genuinely profitable enterprise, generating $4.42 billion in operating profit. But the prospectus shows exactly where that profit goes. It is being redirected to cover a massive financial bleed elsewhere in the corporate structure, the Artificial Intelligence Division, XAI. Building language models and running data centers requires immense physical infrastructure. The XAI division is burning cash at a rate of $28 million every single day, culminating in a $10.2 billion annual drain. This text on the data dashboard isolates the net reality for the parent company. Driven by XAI spending, the organization loses roughly $2 million every hour. Moving from operational cash flow to the balance sheet reveals liabilities that aren't immediately apparent in the top-line revenue numbers. During their review, PwC auditors explicitly flagged $9 billion wrapped up in GPU lease agreements. The auditors classified these transactions as failed sale leasebacks. This accounting intervention forces $9 billion in related party debt directly onto the balance sheet, bypassing standard liability reporting and fragmenting the company's financial health. To justify a $1.75 trillion price tag, the S1 relies heavily on a $28.5 trillion total addressable market. But 93% of that projected market relies entirely on capturing the AI sector. That AI market projection is currently unproven, and it is completely detached from the company's core space launch operations. While the public face of the company is a space monopoly, the S1 shows that investment capital is currently subsidizing an experimental AI venture. The financial data in the S1 is concerning, but the corporate governance structure it dictates creates a more permanent risk. The IPO establishes a controlled company structure. This legal status allows the corporation to bypass standard NASDAQ rules, requiring a majority independent board of directors. Power is completely concentrated. Elon Musk simultaneously holds the titles of CEO, CTO, and chairman of the board. Looking at this governance graphic, we see the concentration of power. Through a dual-class share structure, Musk retains 85.1% of the total voting power. For industry context, Mark Zuckerberg maintains a 61% grip on Meta. The 85.1% threshold here represents one of the most extreme control structures in modern IPO history. With no independent board oversight, there is no mechanism to legally challenge or check the CEO's capital allocation decisions. Public shareholders are accepting trillion-dollar financial exposure, but they are purchasing exactly zero control over their investment. These S1 disclosures have caused a stark divide in how different classes of investors are approaching the stock. Institutional fiduciaries bound by strict risk parameters are actively boycotting the IPO. The Danish pension fund Akademiker Pension, which manages $25 billion in assets, publicly refused to participate. These institutions have officially blacklisted the stock, citing unacceptable governance risks and labeling the equity grossly overvalued. Contrast that institutional retreat with the behavior on the trading floor, where retail investors are exhibiting intense fear of missing out. The underwriters specifically designed a 300% retail allocation to drive this exact buying momentum. Caught in the frenzy, retail traders are looking past a 110x price-to-sales ratio, a multiple that dwarfs the industry average of 5 to 10x. They are also looking past the warning legally printed in the prospectus, the explicit admission that the company has a history of net losses and may never achieve profitability in the future. This has resulted in a market where institutional risk models point to an exit, while retail demand continues to be driven by founder reputation and future vision. This disconnect has sparked a debate across financial media. Is this IPO an intentional financial scam? By strict legal definition, it is not a fraud. Every massive loss, related party debt, and governance flaw is transparently and legally disclosed right there in the S1. Rather than a scam, the market is witnessing the formation of a massive speculative bubble, driven by narrative economics and faith in the founder. To understand the psychological mechanics at play, we have to look at historical precedent. The closest parallel is the 2000 dot-com crash. During that era, companies generating zero profits were awarded billion-dollar valuations based on the promise of future technological dominance. Companies like Pets.com became symbols for narrative-driven investing. They ignored core fundamentals, burned through capital, and eventually collapsed to zero. The market counterargument points to Amazon. Jeff Bezos ran losses for years to build infrastructure, surviving the bubble to eventually justify a multi-trillion-dollar valuation. The ultimate gamble for today's retail investor is guessing whether they are buying the next Amazon or the next Pets.com. The DD Financial Analysis Report issues a clear verdict. Traditional fundamental investing rules simply do not apply to this asset. Risk-averse investors should follow the institutional lead, respect the red flags disclosed in the S1, and avoid the stock entirely. For those who insist on participating, this position must be categorized strictly as speculation, not a fundamental investment. This hazard graphic lays out the recommendation. Do not exceed a maximum portfolio exposure limit of 1 to 2%. Anyone taking this position must be psychologically and financially prepared for a 70 to 80% total loss if the AI market fails to materialize. Surviving the stock market requires reading the numbers instead of buying the narrative. Gravity eventually catches up to every trillion-dollar moonshot.